Singing. 8675309. What a classic video. All right, gang, welcome to our sales training webinar. I want to empower you all to understand how powerful your life insurance license is, right? And we can do so many great things for people beyond just life insurance. And you just have no idea the power that you have. And once you unleash that power, man, you could help so many people. It's just amazing what you can do with a life insurance license. You don't need to be a certified financial planner. You don't need to be Series 6, okay? This is going to totally empower you. Every client you sit down with, right, or most of them, I should say, hope to retire one day, right? Yes, there's some that are already retired. There's still stuff we can do for them, but other people that aren't retired yet, everyone hopes to retire in some kind of financial dignity. And you are empowered with a life insurance license to offer them products that can make a real impact in their retirement. Everyone we sit down with could be a Roth IRA opportunity. We're going to talk today specifically about IULs, right? And you know, when you talked about retirement planning, where it says, well, I've got a 401k. Oh, really? So you got one of those tax deferred things, huh? Well, that's great, you know, but you have your thought about doing anything tax free. You know, a lot of people don't even have not started a Roth IRA, you know. And so I want to give you sort of a framework to help you understand where we operate in somebody's financial planning life, right? And I've gone over this before, but again, I want to frame this properly so you understand where we operate, okay? And this is the classic financial pyramid. All kinds of ways to show this, but it's all the same idea that you got to have the foundation set before you can move up it, right? And the foundation of a financial pyramid is your financial security plan, okay? Security meaning safe, secure. You know, and as you start from moving from the bottom of the pyramid, the foundation to the top is where people involve themselves in asset growth, increasing wealth, right? Where your assets are in, you know, risk vehicles where you can, if you can handle risk, you can handle a higher potential reward. And there's ways to manage that. And there are people to manage that. People with Series 6 licenses that operate in that zone of helping people increase their wealth, right? But how many times have we seen when people have put all their eggs in one basket in the increasing wealth side, right? And all of a sudden the market crashes, and when they thought they were going to retire has extended several years. And so we operate in safety and security. We don't like to lose our clients' money, right? And so when you look at this middle ground, this yellow area, this is where we operate, right, with life insurance licenses. This is why we don't need to operate with the idea that you have to be a certified financial planner. Those guys have their place, right? But we operate here, and you've probably heard it, some of the financial planning advice that you should have. It's based on your age, percentage of your assets you should put at risk. Like if you're 25 years old, you should probably have 25% of your assets in something safe, and 75% you can take advantage of the market risk, you know, and the market growth. And then as you get older, you're 50, maybe 50% in safety, 50% in risk. When you're 75, 75% safety, 25% risk. Probably heard of that. Well, guess where we operate? We operate on that first number, okay? So wherever that person is, this is our specialty, right? And we get commission on helping people on that side. Those guys, they try to take it all, right? They try to take it all. In fact, there was a coup going on about 10 years ago. Some of y'all insurance agents remember that the securities guys wanted to take over the IULs. They were lobbying. They were like, there was a rule they were trying to go for where we as life insurance agents could even sell index universal life. They're trying to steal that business from us. Why? Because we're taking business from them, you know? So thank God that didn't go through, right? Cooler heads prevailed. But this is where we operate, man. Savings, right? Retirement savings, debt reduction, personal savings, emergency cash. These are things that the client can control, that they don't have to avail themselves of risk, and it's something that they can depend on, and that their retirement isn't dependent upon the market per se. And we've got great vehicles to do that. So that's where we operate, okay? So you can be empowered to talk to clients about retirement planning with Index Universal Life is one of the chief ways that we do it. You know, ways that those other guys at the top of the pyramid, that, you know, they don't really know about it. They don't understand it. Plus, they don't make as much money with it, right? Because they make a percentage on managing money. Whether the client loses money or makes money, they make a percentage on their money. We get commissioned up front. There are renewals for sure, but we're trying to put them in the best position from a safety security standpoint. And of course, buzzword, tax-free, okay? So when you understand the products at your disposal that you can take advantage of, Index Universal Life, putting someone into a Roth IRA, you know, like the National Life Group product, they have, I think that's our only company that allows someone to put monthly contributions into a Roth IRA, into an annuity that can be labeled as a Roth IRA that can give them advantages of tax-free withdrawal of that money, lifetime income riders, and so on down the road, right? You can write that on someone. If they got $200 a month to put into something like that, you can get them set up with a Roth IRA, okay? Today we're not going to talk about those products. Today we're going to talk about one of the most effective products that you can get them hooked up in, and that's Index Universal Life. And we have been writing a ton of it lately, particularly on the para appointments. Like Hal Cater got, I think, 27,000 issued yesterday of Index Universal Life. Chris Long, like I think 29,000 got issued paid in 1 week on Index Universal Life, and some annuities, but mainly Index Universal Life. On these teachers' appointments, guys have been killing it writing Index Universal Life, helping clients out. And I have myself, like some of my mega premiums have come from selling Index Universal Life with a tax-free retirement planning in mind, okay? So you absolutely have this opportunity. And so what I'm going to do is I'm going to have my buddy Sam Lauer talk to us about a cool tool. And we presented it to Gina Hawks, and you know, we're hoping that maybe the Alliance will adopt it. But even if they don't adopt it as a company, I think we as individual agents should take a look at it, and it rocks. And what I asked Sam to do is, you know, show us the tool, but really show us the tool in light of how he would show it to a client, to show them the cost, you know, the cost comparison of putting their money into a tax-deferred vehicle versus an Index Universal Life. And it's just tremendously compelling. And I think this is a great product. I think it's a great tool for us to show people who have no clue without really getting too overly complicated. And it's very dynamic too. So I'm sold on it. Sam's been using it for quite a while and been successful in selling IULs with it. So I'm going to turn over to my buddy Sam. Hold on.
Hey, Alex.
Yes.
With that pyramid that you showed,
yeah,
the IUL also operates in that blue section because of the living benefits.
Oh, yeah.
which I will show in my presentation. So IUL, not only the tax-free savings, but also the premature death, which completes the tax-free retirement, and the living benefits.
Yeah, the living benefits are awesome. All right, man. So take it away, Sam Lauer.
All right. Okay, this I kind of came up on my own to kind of get the conversation started with people. And the first question I ask is, what do you think will happen to income taxes in the future? Well, based on, here it is right here. Based on our debt that we have, fast approaching 27 trillion. So when I ask this question, never have I had anybody say taxes will go down. They're always going to go up.
That's right.
So basically, I tell them there's two buckets where you can put your money. You can put it in a bucket where it's always forever going to be taxed. Like, what are you doing for retirement? Oh, you've got a 401k. You're putting money into that bucket, not knowing what taxes you're going to pay when you retire. And it's going to be forever. You're going to be taxed on that money. So which bucket would you rather put your money in? Oh, the never tax bucket. That's a wise decision. Well, there's three investments in that bucket that you can put your money into. Tax-free municipal bonds. Well, do you want to buy tax-free municipal bonds from the city of Chicago, New York? You know, there's going to be some risk involved. You can also put it in a Roth account. Well, what are the problems or downfalls or the cons of a Roth account? Well, if you make too much money, you can't have one. And if you have a Roth account, there's a maximum you can put into it. Also, with a Roth account, you have to wait 5 years before you can get some of that money out for just a few special purposes. And with a Roth account, you have to wait till age 59 and a half to take money out. Now, there's no required minimum distribution, so that's very attractive to people that aren't going to use the account and are going to pass it on. But with the new legislation, you know, when you do start taking it out, or if you don't take it out and it is going to your heirs, they're going to have to take it out over a 10-year period. Okay, so this was billed as a sales tool by Alex. And I want to say that, yes, it's going to help you with sale of IUL product, but it's more of an educational tool because you're going to educate the client and it's going to sell itself. So we don't really want to try to sell the prospect. We want to educate the prospect. So this is an Excel spreadsheet. So numbers don't lie. So this is going to show a side-by-side comparison of their current plan and a tax-free plan. So I don't tell them that it's life insurance right off the bat. So in this area, we're going to put in their age, when they want to stop saving, and a 35-year-old, their retirement, official retirement age is 67. So I'm going to show starting to take money out at age 68. So the first thing I ask is, you know, what is your working tax rate? And this is right there in front of them, and they're going to say, well, I'm in the 24% bracket. So I fill in 24%. Then I ask, what kind of fees are you paying? Well,
Guys, please, if you you are talking with someone else in the phone, please assume it's you and mute your phone.
Somebody needs to mute.
Yeah, hold on.
Okay, yeah.
Okay, Sam, you can unmute. I muted you.
Okay.
Go ahead.
Okay. So just for participating in a qualified plan, there is a fee. Now, depending on the size of the company, if it's a smaller company, you're going to be paying more of a fee than if it's a huge company like UPS, where there's thousands of employees. So just to participate, it can be anywhere from 88 basis points to 188 basis points. Then on top of that, people don't realize what kind of fees they're going to pay if they have mutual funds in their plan. Forbes magazine says that the average cost is about 4%. So the plan fee plus the mutual fund fee, they can be paying anywhere up to 5 to 6% and don't even know it. Now, one thing that's nice about this program, there are a lot of videos that you can use, and I just want to show you one about fees. Well, if I can get it down here. Okay, can everybody see Tony Robbins?
I learned so much about the abuse that happens to the average person. It's mind-boggling.
Well, you are a board member at America's Best 401k.
Yes.
And you've specifically looked into the fees that people pay at 401ks and the fact that most people don't even know that they pay a fee.
This is the most amazing thing. It's a $4.4 trillion industry that for 30 years, they didn't have to tell you what they were charging you. Only 3 years ago, the Department of Labor changed the rules and said, you got to tell people what you charge them. Wow. So now they do that by giving you a 35 or 50-page disclosure document that if you have a PhD in finance, maybe you can figure out the hidden fees.
Yeah, good luck.
So here's what you have to know. Most people, 58% of the people don't even think there are any fees. I did 3 core messages for your viewer. 1, fees matter and you're paying them. A 1% in fee, because of the compounding over time, costs you 10 years of retirement income. The average person thinks they're paying less than 1% or nothing, and they're paying 3.1%. That's 30 years of fees. So I'll give you an example. If you have a 35-year-old person, they have $100,000 and they put it in the market and they let it compound for 30 years till they're going to retire, and they're paying 1% in fees, they have $761,000, which is nice growth from that time. But if you paid 3% in fees for the same stocks, you have $432,000. So in other words, you have 76% more money if you have less fees. Or in the other view, you have 19 years less income. So people don't understand that fees matter.
That's huge.
Yeah, that's pretty powerful. Let me get this back up here. So basically, I say, okay, you know what fees average, what do you want me to put in there? I let them tell me. So it's their number. So let's say they say 3%. Fine. Okay, let's go to retirement tax rate. If you keep your current plan, what kind of tax rate are you anticipating in retirement? Well, I don't know. I think it'll be more. Well, let's just put in 30%. Now, what about your current plan rate of return? Well, I don't know. It's been pretty good. We've had, kind of a bull run here lately. Well, looking over the last 20 years, the average of the market is about 5.6%. Now, down at the bottom, you see the CAGR. That stands for compound annual growth rate. Now, why are those different? Well, because average it just averages numbers. It doesn't take into account loss of principal when the market goes down. So basically, a good example of that would be, okay, you've got $1 and you get 100% return the first year. Now you have $2. You get a 50% loss. Now you're back to where you started, $1. But if you look at averaging those two, 100% minus 50 is 50 divided by 2. Your average return would be 25%, but you have nothing to show for it. So there's a difference when a CFP or a money manager says, well, your accounts averaged 8% over the last 20 years. Well, yeah, average versus what actual is totally different. Now we drop down to the tax-free plan. So based on the S&P over the last 20 years, the compound annual growth rate through 2019 was about 4%. With the tax-free plan, it's been around 7%. Now, why the difference? Well, if you look at the first 3 years, 2000 through 2002, the market had a negative return. The tax-free plan had 0 return. So with the tax-free plan, your money is not in the market. The market just determines what your return is. So there's a cap and a floor. The floor is 0. So when the market tanked 10%, 13%, 23%, you had a return of 0. So you lost none of the principal. So the account value when you're in the market went from 100 to 60,000, and in the tax-free plan, no loss. Now the next year, a 26% return. Well, again, with the tax-free plan, you're capped at the maximum you can earn in any given year. That cap in this particular situation, this particular company is 13%. So if you look at the first 4 years, you're still at a loss with the current plan, and you have 113,000 with the tax-free plan. So that's why the tax-free plan is going to outperform the plan where your money is in the market if you have down years. Okay, let's see here. Let's go over here. There's all kinds of little things that you can pop up with this program, which is nice because you can kind of design it to show what you want. A lot of talk about herd immunity here lately with the coronavirus. Well, how about herd mentality? Are you just following the herd? If you want to be wealthy, just find out what everyone else is doing and do the opposite. So the difference between 10% of the people who make 90% of the money and 90% that struggle to make 10% of the money is what they invest in, because their thinking is different. So if you're just following the herd, someone is in waiting, your favorite uncle. There's 3 risks: tax risk, market risk, fee risk. Now, we already talked about one way that you can eliminate the tax risk, and that's with a Roth IRA, but you still have the market risk and the fee risk. So what I can show you, Mr. Client, is I can still eliminate the market risk with the tax-free plan, and then I can greatly reduce your fee risk. Here's more proof of the 401k becoming obsolete, is what you can do instead. And that's what I'm going to show you, what you can do instead. So basically, this sums up the annual cap and the floor. So the yellow down at the bottom, it says you have full market risk, you have taxable gains, and you have hidden fees. Where with the tax-free plan, there's no market risk, tax-free gains, and fully disclosed fees. So if you need to show them how it works, this is a simple illustration where when the market goes down, you don't lose anything. And then at the end of each year, it resets, and then you participate in upward movement the next year. All right, let's talk about the comparison. When you put in the 24% tax, after tax, if we're showing the client that after tax, if you put 10,000 in, that's like putting 13,000 into before tax into a 401k. So here is showing the annual fees of 3%, and in the tax-free plan, all the fees are set and included. So at age 45, here is what you would have paid in fees over the first 10 years. Now keep in mind, with the tax-free plan, those fees are set. With the 401k, those fees are compounding annually. So the more you have in your plan, the more you're paying in fees. So if I go from 45 up to 55, now the fee difference is huge, $81,000 difference over 2 years. Looking at the account balance, the tax-free plan has more in the cash account balance than the qualified plan. So again, if you look at the difference between the tax-free plan and the qualified plan, I'm going to go back to age 35. Down here, it shows the death benefit. If something happened to the person in the first year, the beneficiaries after taxes would get around $9,000. With the tax-free plan, the death benefit would be $373,000. So basically at this point, I say, if you haven't figured it out by now, the tax-free plan is life insurance. Life insurance, because of 3 congressional acts back in the 1980s, is protected because it's covering widows and orphans. So the government, with those 3 tax acts, determined how much you can put in to a plan and what the minimum death benefit would be, and keeping it a non-MEC, a modified endowment contract. So all of these numbers that I'm showing you would be a non-MEC and totally allowable by current tax law. So let's amp this up a little bit and go back to age 55. Now you see down here the death benefit, $238,000, and $750,000 on the tax-free. So this is showing the total advantage of the tax-free plan at almost $600,000. Now, earlier I talked about living benefits. Here is showing the benefits while you're alive. Not everybody's going to die suddenly. So you have accelerated death benefits if you have a terminal illness. You have critical illness if you have a heart attack, stroke. So you have access to the money if these illnesses happen. So it's a it's basically long-term care coverage built into the life insurance. Now this really gets their attention down here. Here it is showing at age 68 that the retirement income per year that would be taken out would be $108,000. Well, to take out $108,000 after taxes, you'd actually have to take $154,000 out of the qualified plan. So if we go up to age 70 and hit enter, this is showing that in one more year, or a little bit over a year, because you got 154,000 left, you're going to be out of money by the age of 72. Over here with the tax-free plan, it continues to pay income via policy loans. So this is a whole concept that I'm really not going to get in depth with, but it basically, your cash value continues to earn interest because you're taking loans from the life insurance company for income, and it's tax-free. Questions at this point? Comments, Alex?
The same thing when you see taking loans from the insurance company. We just do want to stress that it's a loan, but we don't have to pay it back. If we don't pay it back, then it just offsets the death benefit.
Correct. Yeah, good point. Great point.
Yeah, sorry, I was muted. Kind of spilled my water too. But I think it's what I love about this tool, and have you noticed those little red little dots expand out different points that you can just pop up. You don't have to click out of the tool. It's inside the tool, you know, whether it's a video or whatever, and you can totally customize this to your client's questions. So if the client has a question, you just go to the appropriate button. Of course, you kind of have to use it and know it, but you know how in the PowerPoint, we have to go to that slide. Well, you know, this power of indexing, for example, we have that same slide, but you just hover over the red dot and it shows up. And I think it's very compelling, the story that you can craft for each individual client when they have questions, right, Sam? I mean,
yeah,
they have questions. You're like, oh, well, let me explain that, right?
yeah. And here's the lost decade, 2000 to 2009. The market basically was flat. Well, with indexing, you would have earned 5%. So, yeah, it's a very powerful tool. It can be used in premium financing. One thing that a lot of people will say is, well, hey, I get a match with my 401k. Oh, okay, let's put that in there. How much is that? Well, the maximum is like $3,000 per year. All right, watch what happens down at the bottom. They're still out of money by age 72. Why is that? Well, the fees have gone up because they've been paying fees on that money. And then the taxes are also more. So if we change this to 71, they've still got enough in there. So I'll put 72. Okay, balance 0. Here's how much income they had, 536,000. And if let me take some of this off of here. So you can highlight about anything you want. You can just click on the current plan, highlights that. And then with the program, you get weekly webinars where they go over and train you. There's, like I said, the prospect videos. There's how-to videos that show you how to put the IUL numbers in to the program. There's graphs. I mean, I try to keep it simple, stupid. So I believe in the KISS method. So a lot of things that I haven't showed you that is in there, but like Alex said, they're taking a look at it, something to offer you, and you know what the cost will be. That'll be all figured out as far as having that educational tool to sell more IUL business.
If you could address, Courtney and I were talking, and she's just getting involved in these type of ideas. She's a brand new agent, and she was having a debate with this physician friend of hers, and her physician friend was saying, well, you know, the downside of this is there are caps, and what were the, Courtney, if you could unmute, what were the objections that this doctor was expressing to you?
Let me pull it up real quick. But she was merely knocking the whole situation but let's see.
Well, and this graph here, Courtney, shows the last 20 years. So which would you rather have, 218,000 or 376,000?
Well, I mean, I would rather have the more money, but she wanted, because it was all on a post and somebody asked for some advice. So I actually said, start saving for the future. And I had got a couple people off of this, like, hey, tell me more about this. So then she came back and she says, well, they're not really good. She says, the return is only on the index, not the dividends. Your maximum return is capped. Participation rates lower your return, which I didn't know enough to fully come back and have a conversation with her about it.
Yeah.
But I did say that you have, you know, your 401k, you still have fees with your 401k. So there's not necessarily a plus side to that.
Yeah, and that's where up here, when you say, you know, what's your tax rate, they're putting the number in. You know, what's your current plan fees? Well, I don't know, but they're pretty low. Well, what do you think? I mean, if I change this to 2%, watch what happens down there at age you run out of money. Oh, they got 2 more years of income. Wow. Okay, well, my current plan, I think I'm getting like 7%. Okay, let's put that in. No, you got 4 more years. So when you put it side by side, which you in the past have not been able to do, you know, you're working on a 29-page illustration, which shows a guarantee where it runs out after 20 years because they're charging the maximum rate and 0 return. I mean, you can use this and not ever show an illustration. Now, when you're talking to professional people, they're going to say, well, let me talk to my CPA. Well, you know what the CPA is going to say. Oh, don't do that. That's, you know.
Because they want the benefit.
Yeah, and a lot of them will, a lot of the CPAs will write their qualified plan. So if that ever happens, I say, well, let me talk to the CPA. I'll show them what I'm showing you, and educate them because they don't know.
Okay. Yeah, because one of the other things that she was saying, she said that it only benefits the person selling it, which, the only benefit to me is, I get a little bit of money, not like.
Okay, well, this shows, well, here's the fees that you're going to pay to age 72. And here's the fees you're going to pay with the tax-free plan. Yes, I get paid a commission. My
Mine's over
commission
here on this
comes,
side. I offered twice and she didn't want it. So.
Hold on. Let me mute. Go ahead.
yes, I get paid by the insurance company out of their profits, not out of your tax-free plan. But you can see here, you're saving $367,000 in fees.
That's quite a bit of money.
Yeah. And then at age 72, excuse me, you still have 5 more years of income, but your total advantage is over $1 million because of the taxes that you would have paid with the qualified plan, the fees you would have paid, and the death benefit from the life insurance contract. And you're getting all of these living benefits, tax-free income for life, which reduces your Part B and Part D Medicare premium. A lot of these high wage earners, they're paying $500, $600 a month for their Part B premium when they go on Medicare.
Sam, there's a question on why don't we show equal annual contributions, like instead of 10 and 13,158 in the current plan and 10,000 on the tax-free plan, just showing the same number and then comparing that. Is there a reason why you showed less than that?
Well, it's because the tax-free plan is after taxes.
Got it.
It's an apples to apples when you have the current plan at 13.
Got it.
And the tax-free plan at 10. It's the same amount of money going in.
Yeah, I missed that part. I missed that part. Okay, that totally makes sense.
So if they're in, let's say, the 35% tax bracket.
And that's where the adjustment is. Okay, I got it.
So then that means after taxes, you're putting $8,500 into the tax-free plan.
Yep.
So all the numbers here on the tax-free plan side are set because you've put in the numbers from the IUL illustration. So you can't change those, but these you can change depending on what these numbers are up here in the box. So this, going back to the tax-free plan, it has averaged about 7%, but I like to show a little bit less on the illustration and on the side-by-side comparison. So you can show anything here as long as you use that when you do your IUL illustration.
No, notice everyone how Sam is just in educator mode. He's not in salesman mode. He's in educator mode. He's very calm and nurturing, and he's got his DJ voice on. He doesn't make any bold statements. He lets the client answer questions.
and then it's just a very simple question at the end. Alex, would you like to see your numbers? And if they say no, move on.
Move on.
There's no sense of messing. If they don't see the power of this, then you're not going to convince them.
Right. Because it's compelling in and of itself. And then, I mean, you should be convinced. I mean, you're a life insurance agent. You should be thinking, wow, how about my plans, you know?
And then I failed to show down here, there's all kinds of things that you can use. This is showing age 72, which I had on the comparison, and it shows your current plan, you're out of money at 77, where the tax-free plan pays that income to age 121. You have saved $231,000 in taxes, and you've saved $367,000 in fees. You've gotten additional income, additional death benefit, and at age 72, your advantage is $1 million. So you can make a PDF of it, send it to them. I mean, you want to keep it as simple as possible.
Yeah. What I love about this, Sam, is you're not showing a dadgum illustration. If you want to lose a client,
Yeah.
show them an illustration and try to explain yourself out of all the other questions that come up. Oh my gosh.
Yeah. Yeah. So there's just so many tools in this thing. And then, of course, all of the videos. Now I need to go back here. So I'm going to show you the how-to resources here. So there's training that's included with it. And then whenever they have a update, software update, you just click and it downloads it. This is a complete tour of what I kind of went over, shows how long the videos are. And then they've got a scripted PowerPoint where you can verify, validate, and answer all of their questions. It's got a illustration on 529 versus IUL, why it's better to have the IUL. And probably one of the biggest things is the death benefit would complete the 529.
Yeah, 529 is the college planning fund that
Yeah.
you can put money into specifically for college, and that's it.
Okay, this last one, the CARES Act opportunity, that's a big one. And I'll show you here something else that's provided. They have samples. So what I did was I pulled the age 35, 10,000 a year. So when you're showing this to somebody, say, hey, how old are you? I'm 34. Okay, I'm going to show you a 35-year-old, what it would look like. How much are you putting in? Oh, 20,000. Okay, 5,000. So there's all different ages you can use. And then here's the CARES Act ones. The CARES Act, if anybody has been affected by COVID-19, and I think everybody has, you have an opportunity through the end of the year to take out $100,000 out of your qualified plan without any tax for early withdrawal, and you can pay the taxes on the $100,000 over the next 3 years. So these down here show like age 40, the loans would pay the taxes. So it shows, let me bring it up if it will come up.
That's pretty cool.
Yeah. So this is an illustration showing the 100,000 taken out of a qualified plan, put into the tax-free plan, and then paying the taxes. So I'll let this load up here. And okay, so this is a 40-year-old, and you can change these numbers like I showed earlier. But if somebody had 100,000 in their current plan, this is showing the scenario. If they transfer that 100,000 over and not put anything else into it, and then at age 71, start taking out the 25,000, they would have income to age 121. So again, you have the death benefit, you have the accumulated account balance. I've got to put in, I don't know why it's not showing that, because there's a 4.5% return. Oh, that's because they ran out of money. So 70. So again, difference in the fees paid, huge difference, but that's just taking 100,000 and putting it over. And you can see in the first year, they're transferring the 100,000 over a 3-year period. So not to make it a mech.
Yeah.
So 33,000, you see the balance here after the fees paid and the taxes paid. So going to age 44, now they've got the full 100,000 in there and it's growing.
Wow.
It's pretty powerful.
That's pretty cool, man. It's pretty cool. People are asking how they can order this, and we can get them that information, Sam. Obviously,
Yeah.
through you. And look, I don't get a cut on this. I don't care less. I care less about, we make money with it, not because of it. Well,
Right.
because of it, but it. $69. Now, look, that means you're on the phone talking to people that are good candidates. So, Sam, talk about the prospecting. Like, who are good candidates? The typical profile of a candidate for an IUL like this.
Anybody that is working and has an income.
Right.
Because
That's what I was hoping you'd say.
You can write $50 a month. It doesn't matter. Once they see the side by side, they're going to say, well, I'm not going to participate in my company plan anymore, or I was thinking about joining it. Now they've got a better way to save, and they've got access to their cash values through policy loans.
Absolutely.
And the living benefits. We don't want to.
Oh, yeah, that's right. Let's not gloss over the living benefit.
And the death benefit.
Oh, by the way, let's not forget those. By the way, you can't really use the term investment with this product, right? I mean, what is I've heard different things about being careful as far as terminology. Is that a thing, or is that not?
No. You can use it as an investment, but you just have to tell them that it's life insurance.
Life insurance.
Death benefit first. All the other things are gravy.
Right. That's the point. It is.
Yeah.
Death benefit is what you're purchasing. All the accoutrements of it allow you to take advantage of the other stuff too.
Right.
All right, man. Well, thanks, Sam. Thanks.
Yeah, everybody that's still on, just let Alex know, what you think of it. You know.
We'll hook you up.
Yeah.
Anyway. Fired up. Thank you so much, Sam. This was just so productive. And I think it got people thinking along the right way of what they can do to help their friends, family, clients. Every client literally is a prospect.
Yeah. And anybody, if anybody knows business owners that have 401k plans, it's a great way to come in and say, hey, here's something that's an alternative to the 401k, or, hey, if you want to do more than what you're doing with your 401k, let me show you this.
Yeah, you're not like saying, oh man, you should stop that 401k. You should do this. You're letting them make the choice, right?
All right. Oh yeah. And then once they see this, they're going to say, well, why am I doing my 401k? Well, yeah. Why are you?
Right. we don't want to ever say like either or whatever. Let them come to that decision, because it just comes down to, okay, here are the benefits of this, here are the benefits of this. What do you want to do? You keep both. You can emphasize one over the other. You can, so
Yeah, we make decisions like that every day.
every day.
Do I buy this TV or this TV? What are the pros? What are the cons? And then, oh yeah, this is the right one. So
Exactly.
no selling, just educating.
Educating. Very laid back. I love
Yeah.
your style, man. All right,
Well,
gang.
thanks for letting me share.
Oh, man, I appreciate it, Sam. You really helped so many people out thinking right. So anyway, gang, there you have it. Hopefully this will help you and in your striving to become a professional in this business, because, man, you're armed with an awesome life insurance license that you can help so many people if you use it properly. If you totally use it properly, and that's expanding your mind with all the tools you have available to you. And man, you can be powerful out there. So thanks everybody. Thanks for plugging in. Thanks, Sam Lauer. You guys rock. Let's do this thing. Take care. God bless.
Say, Alex, before you leave, did you want to address that question about that 403B?
Okay, I didn't catch it.
Courtney had that question. Should you have someone stop?
Well, yeah, so 403B or 401k. 403B is really like a 401k in that it's typically a defined benefit, or it could be, defined benefit program that's typically invested with an approved vendor in a teacher's district. There's usually 4. There's like a group of vendors like Voya, AXA, several of them. And what those guys typically try to get them to do is do a payroll deduction into a tax-deferred vehicle. So it's no different than a 401k in that same regard, that it's just the same tax, it's a different tax code. Instead of 401k tax code, it's 403b tax code, and then they put it into an investment vehicle that's tax-deferred. And that's the magic, quote unquote, of a 403b, is that's what it is. It's like a 401k, but it's, under a different mode, like with teachers. Teachers and municipal workers are 457, but it's still the same concept. They're putting money away tax deferred. And what Sam shared with you is a comparison of a tax deferred vehicle with a tax-free vehicle. So whether it's 401k, 403b, 457b, it's the same idea. Does that make sense?
And the CARES Act applies to it, just like the 401k.
Right.
They can take 100,000 out of it, pay the taxes over the next 3 years, and like that example showed, not put anything else into it, and it's going to outperform the 403b.
So what's the CARES Act? So I'm sorry, I don't know what that is. Is that the recent thing that came from?
Yeah, from COVID, and what they said was that if you've been affected by the COVID pandemic, as far as losing hours, pretty much a wide open if you've been affected. If you had to stay at home and watch kids or whatever, you can take the 100,000 out by the end of the year and use it, and then pay the taxes over the next 3 years. So you don't have to pay the tax on it in the year that you take it out.
Gotcha.
And there's no 10% penalty. Like
Right.
if you took something out of your 401k prior to 59.5, there's also an additional 10% hit that you take beyond just the taxation on it in that year that you took it out. So the IRS or the government is saying, hey, we're gonna give you a break, no 10% penalty, plus we're gonna let you pay the taxes over 3 years instead of the year that you received 100,000, which then pops you into another tax bracket. So they're giving you a break. And then what Sam showed you is, if you did this program, the tax-free program, with that money being put in over the next 3 years, because you can't dump 100 grand in a IUL, but you can put a third of it in each of the next 3 years, that the plan will eventually, will allow you to be ahead financially, where the taxation is not a big deal. And you're going to, you know, as we've shown with all those programs with IUL versus the tax deferred vehicle, they're going to be way ahead and they'll retire and have money.
Yeah, and you can use the life insurance contract to take a loan to pay the taxes, or better yet, pay the taxes from another source, or the money that you are having going into the qualified plan, stop that and use that to pay the tax.
Yep.
Gotcha.
Absolutely.
Makes sense. Well, thank you.
Uh-huh.
All right. Great question. All right, gang. Thanks a lot. Thanks, Todd, for reminding me. Later, gang. God bless.